Okay, hello everybody. Thank you guys for coming. I'm so pleased to be joined here on the stage by Ben and Jerry. Sorry, I had to do it. Okay, so
All right.
just to sort of get us oriented, because I think we probably have a fair number of software people in the audience in addition to hardware. Let's try to get an idea, like where's the hardware industry at right now? And specifically, Ben, I know that you said it's quote unquote steam engine time in hardware right now. So what does that mean?
Yeah, maybe just as a quick introduction for those who are not familiar with Hacks. So we're part of a global fund of $300 million with a hardware branch. We've done over 200 hardware investments globally. And our main branches are in Shenzhen, where we have an accelerator program to help startups go from prototype to product. And we have another branch in San Francisco to help them scale. So we've invested in categories ranging from robotics, consumer devices, health tech, industrial and enterprise IoT. So I like to say that we're in this kind of steam engine time because really it's a combination of factors of cheaper prototyping, faster prototyping, better platforms to build upon, better ways to launch using crowdfunding, more appetite for new devices from consumers, and new ways to basically promote and sell hardware. In addition, so we're based in Shenzhen for a reason. It's been called the Silicon Valley for hardware, and it really has opened up to early stage startups to do things at even very low volume. So that's really an incredible change, and that's why a lot of things that were in the lab but couldn't transition from the lab to market can now do it in just a matter of a couple of years or sometimes less.
So it's a time of a lot of opportunity. Of course, with a lot of opportunity also comes competition. So the easier it is to create some hardware, the more people you're going to have to be doing it in competition with. So maybe Jerry, you could speak to this. What can startups do in this environment to make sure that they're setting themselves apart from the competition? Like if I'm like, for example, I was looking at Kickstarter recently, and I saw that there's probably 3 or 4 different smart electric skateboards. So what can I do as a hardware startup to set myself apart from the other smart how do I beat them?
Well, so first, I would like to say that there's not much difference between hardware startups and software startups. The same kind of problems that you have in software startups, for example, competition and all that, is the same with hardware. Everything is in let's say dynamic equilibrium. So if there's something that's easier to do, then you have a lot of competitions for sure. Any kind of startup has to find a way, find the defensibility of their business, and whether it's in the technology, whether it's in sometimes more and more in IP. Sometimes it could be network effect, that in the case of Fitbit. So when you ask about how can the startup defend themselves, I think the first question you have to ask yourself is, are you in B2B or B2C business? Because those two are very different, especially in hardware. So B2C, we're referring to like consumer electronics startups, so a lot of things you see on Kickstarter, on Indiegogo. B2B it could be like, for example, for the enterprise hardware, for industrial hardware, IoT applications. Those two are very different animals, and they have different ways of defending themselves. On top of that, also we have to think about, so when you refer to Kickstarter and you assume that those are startups, for what I'm seeing on Kickstarters and on Indiegogo, most of them are projects. So if you have a project, it doesn't necessarily make you an entrepreneur. Entrepreneur has a dream, has a vision that in the long term you want to create a company that will last 100 years or something like that. So if you narrow down that to entrepreneurs, that whether they do Kickstarter, Indiegogo or not, and they do consumer electronics, as in last year in my talk at Cake in Asia, if you want to defend yourself, differentiate yourself from the copycats, there are a couple of things you can do, right? So the most powerful one is brand. If you can build a brand, and that's very good. I think Ben has been helping startups to build a brand in terms of marketing, so we can probably talk about that a little bit more later on. Another very strong thing that most of the hardware entrepreneurs tend to ignore is that actually you can build network effect in hardwares. Network effect doesn't just apply to software startups. So Fitbit actually is successful because of network effect. It's not because of the their wearables is better than the others. And the other things like patent portfolios, user stickiness. So if you have something that people will have to come back to you to use the hardware over and over again, that also helps. So all those things, they're actually not that much different from the software startup. So I wouldn't really say that hardware is like special in terms of that. Yeah.
Yeah, I'd like to build upon that. So I agree with what Jerry said. So you have the patents, you have the network effects, you have the brand. But I think there's been a transition from kind of this maker movement, maker scene, toward much more high-tech products. So today, when I look at the companies we invest in versus 3 years ago, a lot of them are in health tech, a lot of them are in service robotics, And for those, really the key is not in the hardware itself. The key is in the science. So it could be medical research. It could be lab research on physics, on material science. In the case of robots, very often it's AI. So I was looking recently at our recent portfolio of investments. And because everybody's talking about AI, I was like, oh, are we actually doing AI? And I looked at the companies we had, and basically almost every single robotic company we invested in has AI, has machine learning. Almost every single health tech device has some form of machine learning or big data. Because the idea is to collect a lot of data from you to basically detect, prevent, or cure conditions. So basically what I think it is protecting companies more than anything in the initial stage is actually the complexity of what they do.
Okay, so this is, I mean, you sort of just touched on it a little bit, but I know that both of you have said another sort of important thing to understand about the hardware market right now is this kind of maybe explosion, or maybe it's still coming, but the rise of deep tech in hardware. So could you talk a little bit about, I mean, what is deep tech in hardware, and why is that important? Why is that important now?
Well, I think there's a couple topics in deep tech that's been pretty hot recently, and almost all of them involve hardware. So let's talk about AI. Everybody's talking about AI. I have a couple discussions already today, both with Ben and with the other people. So one of the things about the deep learning and machine learning is that you need input data to train. So I think Ben touched on that. And this is what I've been talking about. A lot of these pure software AI startups, you don't have the data. So there's not much open source data library out there. Most of them, academic background, they all train on ImageNet, so the open source image library from Stanford. But outside of that, you don't really have that much data you can train on. So you can be a you can have an IQ of 240, very good in the algorithm, and in school, in PhD program, you have an algorithm that beat up the other paper publishers by 5% or 4% of accuracy. But once you move into once you create your own startup, you realize that you don't have the data. And that's where hardware startups come into play. I totally agree with what Ben said, because a lot of startups, we look at our portfolio, it's the same thing. Yes, they are hardware startups, but they always have a backend, which is cloud, and you have the machine learning running. And this is very important because the sensor startups, the sort of environmental hardware startups that we are investing in, they have their own data. They build it, or they don't have to go knocking on the doors of other big companies saying that, look, I have the algorithm. If you can give me your data, then I can make you smarter. Usually it doesn't work that way.
Yeah, I think to give a few specific examples, we invest in a company called Simbi Robotics. They do a robot that does automated inventory in supermarkets. So it's a robot that basically cruises in supermarkets and scans the shelves. And it doesn't scan a barcode, it doesn't scan RFID, it's pure computer vision. So what's interesting is that the whole navigation of the robot, which is like avoiding people, understanding the map of the place, and making its own map, making sure it looks at everything, this is the easy part. The complex part is scanning the shelves and recognizing every single product, every single brand, to be able to say, you're stocked, you're misplaced, you're mispriced. And this robot is able basically to do a full inventory in about 30 minutes instead of 30 hours. So it's already deployed in a number of Target stores in the US, and this company it's on a great trajectory. Closer to us, to give another example in robotics, another company we invested in from Canada, this one called Avid Bots, they do a robot for commercial cleaning. So everybody knows the Roomba. Maybe some of you have a robot to clean the house. In the house, the constraints, not too hard. It can bump around, it doesn't matter. It can take all the time it wants. If it's not super clean, you won't mind too much. When you're in the commercial space, you need to be efficient. You need to avoid people. You cannot just say sorry after you bump into them, right? So this robot can navigate in the airport, understand where it is, understand what it has to do, avoid people, and clean the whole thing. So what's interesting is that it's a robot, but essentially it's a cleaning company. So when you look at it from the business application standpoint, it makes tons of sense to have a robot do this type of repetitive or dirty or tedious or dangerous jobs. The question is, can you do it at affordable price? And what's amazing is that with the drop of cost in components and the ability to use cloud computing means the machine itself doesn't need to be that smart, because a lot of the calculation you can offload to the cloud. You can do some on board to react quickly, and you can offload a lot of stuff to the cloud. So actually, this one is deployed in Changi Airport. So if you see a robot, say hi to Avid Bots.
Okay, so it sounds like a lot of what you're saying about deep tech is that there's a big software background to these hardware projects. So I'm just curious, because both of you in your work deal with a lot of hardware startups. Have you had to change the way that you work with them at all to kind of reflect that maybe they're needing to build more software now than they were a few years ago? Like, how has that changed what you do?
So I will just give one very, very simple example. So I don't have the real data, I don't have the real numbers, but if I'm going to guess, the second largest AI chipset companies in the world right now is going to be Google. Because they just announced last month. Now we realize that the last year and a half, I think many of the people here try the new Google apps. Like for example, if you just aim the camera at a sign, you would just translate the text into a local language, and then still follow the same font types. And a lot of people try that. So Google has rolled out a lot of services the past year and a half that are pretty amazing. But turns out those are run on their own AI chips, which is on the inference phase. So NVIDIA owns the training phase, and in order to be efficient in terms of inference phase, meaning that using the model to give new inputs to give outputs, Google actually started building their own chips like 2 or 3 years ago. Many of my former colleagues at Qualcomm, they were hired by Google to do just that. And so if you look at, that's a software company that we're not even talking about their acquisition of Nest, which is already 3 or 4 years ago, that they're only building their own chips. So it's pretty bit obvious, actually for us in the business, it's pretty obvious right from the beginning, 3 or 4 years ago when the new hardware boom started. It's not just hardware, it's everything combined. Some of our best founders, they are software background. Fitbit is also driven by software and that kind of thing. That's been the case right from the beginning.
Yeah, no, this is a really good point. Actually, we see more and more software companies getting to hardware. We see more and more like kind of a non-connected or non-smart hardware companies because we live in the physical world. Most of the objects we interact with are physical. They're looking for ways to make them more interesting, bring more capabilities. And what's interesting is that the cost of putting intelligence, not just connectivity, but actual computing power and intelligence into a product has gone down a lot. One of the companies that came out of our accelerator is a company called Next & Co. And they made the first microcomputer that cost only $9. So I don't know what you get for $9 in Singapore, maybe like 2 coffees. Yeah. No, I know I saw the price. It's like $7 in Singapore. So maybe not, maybe 1.5 coffee. So now you can get a computer for that price. So you don't have the screen, you don't have the keyboard, you don't have the mouse, but you have basically the equivalent of an average tablet, which is like a shitty computer, but it's only $9. So for $9, it's amazing. And it has memory, it has connectivity with Bluetooth and Wi-Fi. So the question becomes not so much, is it possible to do it? The question is, what should you do? What is the functionality you want to have? If you want to make a table smart, if you want to make the light smart, if you want to make, I don't know, anything smart, what function could it have? And it's about creativity, it's about user experience, it's about integration. And I think we're not far away from having startups start to make, beyond using platforms like this one for like really low price, we're probably just a few years away of having startups making their own chips.
Okay, so it's a pretty significant change. All right, so shifting gears a little bit, but just trying to continue the sort of painting the picture of where the market's at right now. Ben, I know another thing that you've said is that you see the hardware sector as being pretty undercapitalized right now. So I'm wondering, I mean, obviously we've got startup founders and we've got plenty of investors here in the audience.
I would say the software industry is overcapitalized.
The software industry, but is hardware over or undercapitalized?
I would say it's the other side that got too much money. It's not really there.
Okay, so looking at hardware then, as for an investor or for a hardware startup founder, how do you deal with that? How do you take advantage of that?
So it's a blessing and a curse. Obviously, for us, the blessing is that there's less competition on deals. We're much more visible because most investors have been doing software investment for the past 20 years. Anyone who's doing hardware as part of their portfolio will, let's take an average VC. They would do 10 deals this year. How many are going to be hardware? Maybe 1, maybe 0, maybe 2. So unless they're specialized, they cannot really build a lot of expertise, and they cannot really support startups, especially at the early stages where there's a lot of uncertainty around building the product and delivering it. So for us, it's an advantage. The problem comes later when the company already is starting to build a product, is getting close to market, and they need capital. And sometimes they cannot find it from VC, and they cannot find it for grants, and they try to find it from customers. So that's kind of one of the challenges. Now, the type of things we're looking at in hardware startup teams is, of course, the combination of skills to be able to build the product. So generally, it's electrical engineering, mechanical engineering, and software. Sometimes it's kind of good to have design and business skills. Design can be often outsourced somehow. Business, somebody among the founders will have to pick that up, and they better, pick that up quickly. That's basically what we look at, and we look for a working prototype. It doesn't have to be pretty. We know how to make it really good. And we're looking for a very strong competitive advantage. So that competitive advantage can be in the software, in the science that they've developed, and in some cases in the brand or the community.
Okay, so from the startup's perspective then,
yeah. So actually, I want to add something. So what we've been seeing the past couple of years, especially in Silicon Valley, where money is just too much money, is that, so we talk about hardware startups being driven by software, that's correct. But usually when pure software VCs invest in hardware startups, that usually become disastrous. And because usually they put in money, too much money at too early a stage, and they ask the founders to do the wrong thing. And doing the wrong thing in hardware is different from doing the wrong thing in software. We're doing it in software, we all know that you can roll out one release every day or every week if you want, right? If you have enough manpower, you can do that. But in hardware, if you roll out a product that is basically incomplete or not is actually in mass production, it's actually on the field, it's failing. And if you're hiring the wrong people, so you're hiring a lot of engineers that are not helping you to do the mass, get into the quality thing. So we already seen, I don't want to name names, but there are already a couple of very high-profile failed hardware startups that have pure software VCs invest in them. So that's one problem. And another problem is that if you just check the fact, so one of the facts is that, so VCs put money into hardware startups, they put 50 million, they put 100 million at relatively early stages, think that it's because hardware is more capital intensive, which is not the case. But they failed to check the fact. The fact is that it only took Fitbit 66 million to hit IPO and generate $1.7 billion revenue on the year to hit IPO, right? And market cap of $6 billion. It only took Elon Musk 65 million to build the first prototype of Roadster, so Tesla Roadster. It's not the case. So if you're putting 100 million into an entrepreneur, early stage, building a hardware startup, there's something wrong there. There's definitely something wrong. And actually, it would turn around and kill the company because the whole structure is wrong and nothing's going to work going forward, basically.
Yeah, that's it's true that the image of hardware is probably like about 10 years old.
Too old.
Like there's this idea that it takes, I don't know, 3 to 5 years to do anything. It will cost you $5 million. We have a number of companies that shipped products just based on the first check we signed for them. It was $100,000. They got a product to market thanks, in many cases, to crowdfunding or some grants or some customers. And I was discussing with a Canadian company recently. They do a printer for circuit boards, so you can make electronic circuits on your desktop. And they were back in Shenzhen, and I meet them, and I see, oh, okay, so how are things going for you guys? Like, they said, oh, we sold all the products from our first batch. I said, that's fantastic. So how are you going to finance the second batch? So it's generally like one of the big problems of hardware, particularly those launched with crowdfunding, is that they don't have the capital. Even if there's demand, they don't have the capital to actually make the second batch. So I asked them, so what's up? Are you going to raise funding? They said, no, we're actually going to use our profits. So
there's gross margin, there's operational cash flow coming in.
So they had enough profit to actually do a second batch and keep going, and they have a team of like 8, 10 people in Canada. And Canada is a fantastic place compared to Silicon Valley because not only you can hire people and keep them, but also they cost less. And the government pays you back half of your development cost as R&D cost. So that means that some geographies actually have an incredible competitive advantage. And I think of Canada, think of France, where there's incredible tax breaks and talent that makes it very competitive. I think actually Silicon Valley, unless you're kind of one of those kind of like serial entrepreneurs who already have a track record, already made money for other people and can easily raise money, it's actually a really bad place for an early stage company.
And also, I think if we talk about a later stage, we're seeing a new phenomenon emerging. So the past 10 or 12 years has been a big software lean startup boom, right? And so a lot of growth capital was supplied by, let's say, late stage venture capital, growth fund, or even a little bit of private equity. But they all come in the form of like preferred shares, basically. So they got interest rate and all that. But when hardware startups are growing, what's interesting is that if you look at the gross capital that's required, the working capital that's required, it's basically financing an inventory to the sales cycle. So that's something that the banking industry has been doing forever. So there has always been loans based on, so basically the underlying asset is based on your inventory. So if there's a default, if you couldn't pay them back, they can get your inventory. So we're getting into a situation where a lot of the new financial institutions are now coming to VCs like us and saying that, look, do you have any late-stage startups that are shipping, they're growing 200% per year, but they need working capital? We're happy to finance that at 10% annual interest rate cost. And the underlying is going to be the inventory or the working process basically.
Yeah, it's actually kind of interesting that even though VCs tend to dominate the conversation around financing of startups, venture capital is the most expensive source of capital you can find. Ideally, you would go for a bank loan at a few percent, but the problem is that if you have fast growth, generally a bank would look at last year's sales and say, okay, you sold for $10 million of products, I can lend you like 2 million, 3 million for this year. But if you're tripling your revenue this year and you need to make a lot more products, that's not going to cut it. So it's interesting to see like those, actually you're totally right, those late stage financing options. Another option that's actually quite interesting for late stage hardware companies is actually looking at early IPOs. So not necessarily on NASDAQ, because for NASDAQ you probably need about 100 million in revenue, but for other exchanges like TSX in Toronto, New York Stock Exchange, possibly Singapore, Shenzhen Stock Exchange, Hong Kong, even though Hong Kong is a bit problematic. Actually, it goes back to kind of the old school IPO where you go to the public markets with a company with revenue, with profit, with growth, and you share that growth opportunity with the general public instead of privatizing that growth like it's done today with software.
Okay, so shifting gears a little bit, but I just want to make sure that we cover this. One of the important things I think in the public perception about hardware startups is that obviously you've got to make a physical product, which means you've got to be, maybe you've got to be in a place where that physical product can be made. But here, of course, we've got, one of you is based in, sort of the tech hardware capital of the world.
That's me.
Right. And Jerry, you're based in Paris.
Even though Paris is also a tech capital now.
So I'm curious what both of your opinions are of how important is location now in terms of, do you need to be in Shenzhen? Is that necessary?
So I think that's the wrong, that's the angle to look at hardware startups. Put it this way, our entrepreneurs, including Benson, and we share a couple of like portfolio companies actually, they're everywhere. Because your supply chain is in Asia, your market is in US and Europe. You cannot just pick one place. So you can have your headquarters somewhere, but as an entrepreneur, you'll be flying everywhere whenever it's needed. So there's no notion where you have to be here or there to be successful, actually.
Yeah, it's really about combining the strengths of each ecosystem. The startups we invest in, we've done over 200 investments in hardware, and about 30 of them are Chinese. Everyone else is international companies from US, from France, UK, Germany, lots of places, including Singapore. I think we have 3 investments in Singapore. And it's really about finding where can you find the talent to recruit to do your R&D, where do you do your prototyping cycles on manufacturing, and where are your customers? And as Jerry said, that probably means that even if you have 3 people in the company, you're going to be flying quite a bit, because you're going to do your R&D. If you're in France or Canada, fantastic. Yeah, cheaper, easier to recruit. Then do your prototyping, iterations, and manufacturing in Shenzhen. Some cases could even be somewhere else. If you do something a bit lower tech, we have some portfolio companies that decided to manufacture in Thailand, in Mexico. But generally, Shenzhen on the area, Dongguan is the place to go. And then for early adopters, generally the US market is the most suitable.
I'll give you just one concrete example. So one of the earliest Hardware Club member startups is Misfit. So Misfit was founded in 2011. They sold the company in 2015, so that's 4 years span. And just give you a background of Misfit. So Sonny Vu was born in Vietnam, so he's Vietnamese. Went to the United States, grew up, did MIT, and later on worked a couple of years and then founded the company in 2011. It is this American startup doing wearable 4 years later than Fitbit and Jawbone. They manufacture in, they were the first one who got really big on Indiegogo, I think like 900K or 800K of campaign. They shipped before time. They did their manufacturing in Vietnam. They grew their first market in Europe, so because already in the United States you have Fitbit that's dominating. And then they grew their sales in China in 2014-15, and so bringing in Series C in 2014 from JD.com and from GGV Capital, and in 2015 complete an exit of $260 million to American company that's a fashion brand. And if I call Sony today, he could be anywhere. He could be in Ho Chi Minh City. He could be in the United States, in Boston. He could be in China. It's never the case where I know where it is. And that's the status quo of how it's entrepreneurs.
Okay, so moving back a little bit to maybe a more basic question, but I just want to make sure that we get some information about this out there for the audience. So let's say I am, I've just started my own hardware startup, and maybe I'm based in the US, maybe I'm based in Singapore, maybe I'm wherever, but I'm going to take that flight to Shenzhen to start talking to manufacturers and suppliers. What do I need to, if I'm a first-time founder, what do I need to know? What are the questions I need to be asking when I go in for those meetings and try to find the parts?
Yeah, so this is a tough one, and there's a reason that we basically bring all the startups we invest in to Shenzhen for 4 months. It's because this type of problem cannot be solved in a week, unless you're very, very, very lucky, very, very well connected, and already know what you're looking for. The main reason is because you need to first identify potential suppliers, then you need to check if they have not only technical capability, but also the right motivation, and if they give you the right payment terms. As a small startup, you're not really a business for them. You're an opportunity cost. So for a factory or factory owner to be interested in your project, they have to see a future where you might be a big business, but there's also a good chance that you won't be a big business. So they want to see what they're going to learn with you. How interesting is it going to be to work with you? Will they be able to say, oh, I worked on this project, so now I can get some new customers because I did something difficult. So you need to find this right match. And I would say kind of a shotgun wedding with a factory is probably not the right way to go. So what you want is probably plan to spend some time on the ground and try to talk to as many people who have engaged with the supply chain to narrow down your choices. You want to do your own due diligence. You want to go on site. You want to see like everything from the factory line to how the workers are treated. Even like looking at the workers' toilets, that's kind of indications because they kind of write rents on the toilet door also when they're not happy. So you want to spend time on the ground.
Yeah, I think we're running out, but basically I agree with everything that Ben said, and there's one fundamental difference I think if you want to do a hardware startup you have to know, is that, so in the software startups everybody's talking about let's do it the Marx way, so move fast and break things, right? In hardware, move fast, don't break things. Because if your things broke in the field, it will come back and hurt you. You cannot ship an incomplete product. So like
hardware kills.
There are many, many things you have to take care of. But just keep in mind that all the challenges you manage to solve, they become part of your defensibility, right? So if you're doing an app startup, a software startup, chances are there will be 200 startups doing the same thing. But for all the hurdles you get across in the hardware field, there'll be fewer and fewer competitors that can get over a hump, and so that becomes part of your defensibility.
Yeah, it's like in F1 racing. I think Michael, not Schumacher, was the other guy, the guy who crashed. Ayrton Senna was very happy when it was raining, because he was really good at driving in the rain, and everybody else was kind of slowing down or having trouble. But yeah, no, it's definitely like defensibility. Another thing to have in mind when you work with manufacturing partners is that they are not just a low-cost or whatever executing partner. They actually are business partner. They're just as important as co-founder, because they will teach you how to make things. Most hardware founders have never made a product. It's the first time. They take it out of the lab. They're trying to make it mass market. They have no idea how to do it. The factory knows how to do that. They've done that plenty of times. So they're going to teach you. They're going to tell you what's possible. You're going to try to get them to push the envelope, maybe, and do things they haven't done before. But essentially, they're going to be your teachers.
They're your partner. They are not your contractor, put it this way.
Yeah. Right. All right, we're almost out of time, but I want to get in one more question for you guys really quickly before we go. Just what's the biggest mistake that you see hardware startups make, and how can they dodge that? How can they avoid it?
I'd say, well, an easy one would be to build the wrong thing. It's kind of obvious, and it's not limited to hardware. But the thing is that if you, like you were talking about those electric scooters or electric skateboards, it's a commodity today. You know, you can buy it. So you can try to find a different angle. So it's going to be, I don't know, a little bit faster, a little bit lighter, easier to recharge, foldable, I don't know what. But it's not a very, very strong differentiator. So that's why when you want to build something, try to find something that's really different and ideally quite difficult.
Well, I'll just make it short. So the biggest mistake that we see in hardware founders is that they make too many assumptions. So you can test the market, but if you make too many assumptions and build your product that way, it's going to be very difficult afterward, basically.
All right, great. Well, this has been very interesting, but unfortunately we're out of time, so thank you very much, guys. Please give them a round of applause. Thanks.